Look, I need you to understand something that's happening right now in the precious metals market. Something that most people aren't paying attention to, but should be. Because what's unfolding isn't just another market cycle. It's a structural breakdown that's been building for years, and we're now watching it accelerate in real time. The vaults are draining, and I don't mean slowly. I mean at a pace that's making even seasoned market veterans nervous. Let me paint you a picture of what's actually happening behind the scenes. COMEX silver inventories have collapsed by over 73% since the beginning of the decade. Think about that for a second. 3/4 of the registered silver that was sitting in those vaults just a few years ago is gone, and it's not coming back. But here's where it gets really interesting. In a recent 4-day period, 60% of the remaining eligible silver was claimed for delivery. 60%. In 4 days. That's not normal market behavior. That's panic buying from people who understand what's coming. Now, you might be thinking, okay, but vaults drain and refill all the time, right? This is just normal market dynamics. And you'd be partially correct, except for one critical detail. The refilling isn't happening. The supply simply isn't there. Let me take you across the Atlantic for a moment. London, the heart of the global precious metals market. The London Bullion Market Association vaults have seen inventories plunge by 33%. These aren't small regional warehouses we're talking about. This is where the world's silver has historically been stored, and it's evaporating. You know what's fascinating about this? The mainstream financial media is barely covering it. You'll see endless coverage of stock market movements, cryptocurrency volatility, bond yields. But this fundamental breakdown in the physical precious metals market? Crickets. And that tells you something important. Because the people who understand what this means aren't talking about it publicly. They're acting on it, quietly, systematically, accumulating physical metal while it's still available. Let me explain why this matters more than almost anything else happening in financial markets right now. Silver isn't just a monetary metal. It's not just something people buy as a hedge against inflation or currency devaluation. It's an industrial metal that's absolutely critical to modern technology. Solar panels, electric vehicles, 5G infrastructure, medical equipment, water purification systems. The green energy transition that governments around the world are pushing, it's impossible without silver. And here's the problem. We're already running a supply deficit. Global silver demand has exceeded mine supply for years now. The gap has been filled by above-ground inventories. Those vaults we're talking about, they've been the buffer, the shock absorber that's kept the market functioning. But what happens when the buffer runs out? Think about it like this. Imagine you have a bank account that you're spending from every month. Your expenses exceed your income, so you're drawing down your savings. That works fine until your savings hit zero. Then what? You can't spend money you don't have. That's exactly what's happening in the silver market right now, except the consequences are far more severe than a bounced check. Industrial users need silver, not want. Need. Their production lines depend on it. And when you're a manufacturer who needs silver to keep your factory running, you don't care about the price. You care about availability. You'll pay whatever it takes to secure supply. This is where the paper market comes into play. And this is where things get really interesting. The COMEX, the Chicago Mercantile Exchange where precious metals futures are traded, operates on a fractional reserve system. For every ounce of physical silver in the vaults, there are multiple paper claims on that silver. It's similar to how banks operate. They don't keep all your deposits in cash in the vault. They lend most of it out, keeping just a fraction in reserve. This works fine in normal times. Most futures contracts are settled in cash, not physical delivery. Traders are speculating on price movements, not actually trying to take possession of metal. So the system hums along with relatively small amounts of physical silver backing a much larger paper market. But what happens when people start demanding physical delivery? That's what we're seeing now. And it's breaking the system. When someone stands for delivery on a COMEX contract, the exchange has to produce the physical metal. And with inventories at multi-year lows, that's becoming increasingly difficult. The registered silver, the metal that's actually available for delivery, is a fraction of the total open interest in the market. Let me give you some numbers to illustrate this. At recent levels, the total open interest in COMEX silver futures represented over 1 billion ounces of silver. The registered inventory available for delivery? Less than 50 million ounces. That's a ratio of more than 20 to 1. Now, again, this normally isn't a problem because most contracts settle in cash. But if even a small percentage of contract holders decide they want physical metal, the system can't handle it. There simply isn't enough silver to go around. And that's exactly what's starting to happen. You're seeing it in the price action. Silver recently broke above $55 per ounce, hitting fresh all-time highs. Some markets saw prices spike above $58. These aren't normal market moves. This is a market that's dislocating, a market where the paper price is starting to diverge from the physical reality. Here's something most people don't understand about precious metals markets. There's the spot price you see quoted on financial websites. That's the paper price, determined by futures trading. Then there's the physical price, what you actually have to pay to get metal in your hands. And that premium, the difference between paper and physical, is exploding. Dealers are reporting premiums of several dollars per ounce over spot for physical silver. Some products are commanding even higher premiums, and delivery times are stretching out. You can't just walk into a dealer and buy significant quantities of silver anymore. You're looking at weeks, sometimes months, for delivery. This is what a supply crisis looks like in its early stages. Now, let's talk about what's driving this demand, because it's not just one factor. It's a perfect storm of multiple forces converging at the same time. First, you have industrial demand that's structurally higher than it's ever been. The electrification of everything requires silver. Every electric vehicle uses significantly more silver than a traditional car. Solar panel installations are accelerating globally. 5G networks are being built out. All of this requires silver. Second, you have investment demand surging. People are waking up to the inflation reality. They're watching their purchasing power erode. They're seeing government debt levels that are mathematically unsustainable. They're looking for real assets, tangible stores of value, and they're turning to precious metals. Third, and this is crucial, you have central banks changing their behavior. For decades, central banks were net sellers of gold. They were reducing their precious metals reserves, believing that modern monetary policy had made gold obsolete. That trend reversed over a decade ago, and it's accelerating. Central banks are now net buyers of gold at record levels. They're diversifying away from dollar reserves. They're preparing for a monetary system that looks different from the one we've had for the past 50 years. And while most central bank buying is focused on gold, the implications for silver are profound. Because here's the thing about silver. It's gold's little brother. It tends to follow gold's moves, but with more volatility. When gold goes up 10%, silver might go up 20%. When gold goes down 10%, silver might drop 25%. It's a leveraged play on precious metals. And right now, gold is in a structural bull market. It's making new all-time highs. Central banks are accumulating. Geopolitical tensions are rising. Currency debasement is accelerating. All the factors that drive gold higher are in place, which means silver, with its additional industrial demand component and its much smaller market size, is set up for even more dramatic moves. Let me put the market size in perspective for you. The entire global silver market is tiny compared to other asset classes. The total value of all the silver ever mined that still exists above ground is measured in the hundreds of billions of dollars. Compare that to the bond market, which is measured in the hundreds of trillions, or the stock market, or real estate. Silver is a rounding error in the global financial system, which means it doesn't take much capital flowing into silver to move the price dramatically. And when you combine that small market size with a supply deficit and draining inventories, you have the setup for explosive price moves. Now, I want to take a step back and look at the historical context here, because what's happening now isn't unprecedented. We've seen supply squeezes in precious metals before, and studying those episodes tells us a lot about what might happen next. Go back to the late 70s. Silver went from around $5 an ounce to $50 an ounce in a matter of months. The Hunt brothers were trying to corner the market, but that wasn't the only factor. You had high inflation, currency instability, geopolitical tensions with the Iranian Revolution and the Soviet invasion of Afghanistan. People were fleeing paper assets and piling into real assets. The spike was dramatic, and it eventually crashed when the COMEX changed the rules, implementing position limits and raising margin requirements. But here's what's different now. The fundamentals are stronger. Industrial demand is structural, not speculative. The supply deficit is real and growing. And the monetary backdrop is even more precarious than it was in the 70s. Or look at what happened in early 2011. Silver went from around $25 to nearly $50 in a matter of weeks. That move was driven by a combination of post-financial crisis monetary policy, sovereign debt concerns in Europe, and strong investment demand. It pulled back sharply after hitting that peak, but it never went back to the pre-crisis lows. Each of these episodes teaches us something. Precious metals can move much faster and further than most people expect. The moves are often driven by a combination of monetary factors and supply-demand dynamics, and once a move starts, it can feed on itself as more people pile in. But here's what makes the current situation potentially more significant than those historical episodes. The supply situation is worse, the monetary backdrop is more extreme, and the industrial demand component is stronger and more structural. We're not just dealing with speculative demand or monetary concerns. We're dealing with a fundamental shortage of a critical industrial material at the same time that the monetary system is under unprecedented stress. Let me talk about the monetary system for a moment, because this is the elephant in the room that most people are trying to ignore. Global debt levels are at all-time highs. Government debt, corporate debt, household debt, it's everywhere. And it's not sustainable. The only way to service this debt is to keep interest rates low and keep printing money. But that creates inflation, which erodes the value of the currency. Central banks are trapped. If they raise rates to fight inflation, they crash the economy and trigger a debt crisis. If they keep rates low and keep printing, they destroy the currency. There's no good option. They're trying to thread the needle, but the needle keeps getting smaller. And people are starting to figure this out. They're realizing that their savings in the bank, their bonds, their cash, it's all being slowly confiscated through inflation. They're looking for alternatives. And precious metals are the obvious choice. Gold and silver have been money for thousands of years. They can't be printed. They can't be debased. They're no one's liability. They're real, tangible assets that hold value regardless of what governments or central banks do. Quick aside here. If you're sitting on significant retirement savings, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical gold into your retirement account without tax penalties. It's in the description if that's relevant to your situation. Worth understanding your options. Anyway, back to what's happening in the vaults. The draining of COMEX and LBMA inventories isn't happening in a vacuum. It's part of a broader trend of physical metal moving from west to east. China and India have been accumulating gold and silver for years, not just at the central bank level, but at the individual level. Cultural affinity for precious metals runs deep in those countries, and now you're seeing other countries getting in on the act. The BRICS nations, Brazil, Russia, India, China, South Africa, along with new members like Saudi Arabia and the UAE, they're all talking about alternatives to the dollar-dominated financial system. They're talking about gold-backed currencies. They're talking about settling trade in their own currencies rather than dollars. This is a seismic shift. The dollar's role as the global reserve currency has been the foundation of American economic power for decades. It's allowed the U.S. to run massive trade deficits and accumulate enormous debt without immediate consequences. But that system is starting to crack. And as it cracks, the demand for real assets, for precious metals, is going to accelerate. Now let's talk about what this means for prices going forward. Because that's what everyone wants to know, right? Where is silver headed? I can't give you a specific price target with a specific date. Anyone who does is guessing. But I can tell you what the setup looks like, and it looks explosive. You have supply that can't meet demand. You have inventories that are draining. You have a paper market that's over-leveraged. You have industrial users who need the metal regardless of price. You have investors who are waking up to the inflation reality. You have central banks diversifying away from dollars. You have geopolitical tensions rising. Every single factor that drives precious metals higher is in place, and they're all intensifying. The technical picture is equally compelling. Silver has broken out of a multi-year consolidation pattern. It's making new all-time highs. The momentum is building, and once these moves start in precious metals, they tend to go much further than anyone expects. Here's what I think a lot of people are missing. The price of silver in dollar terms is somewhat irrelevant. What matters is the purchasing power. What matters is what an ounce of silver can buy. If silver goes to $100 an ounce, but the dollar has lost half its value, are you really better off? Maybe, maybe not. But if you're holding dollars that have lost half their value and you don't have any silver, you're definitely worse off. This is about preserving purchasing power. It's about having real assets in a world where paper assets are being systematically devalued. And here's the thing that keeps me up at night. What happens when the general public figures this out? What happens when the average person realizes that the vaults are empty, that there's a supply shortage, that their currency is being debased? You get a rush for the exits. You get panic buying. You get a situation where physical metal becomes nearly impossible to obtain at any price. We've seen glimpses of this already. During the early days of the pandemic, try buying physical silver. Dealers were sold out. Premiums were through the roof. Delivery times were measured in months, and that was just a temporary spike in demand. Imagine what happens when the demand spike isn't temporary, when it's sustained, when it's driven by a fundamental loss of confidence in the monetary system. The price moves we've seen so far, as dramatic as they've been, might just be the beginning. Let me tell you about something called the gold-silver ratio. It's the number of ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 15:1, meaning 15 ounces of silver equals 1 ounce of gold. In recent years, that ratio has been much higher. It's been in the 70s, 80s, even hit 90 at one point. That means silver has been dramatically undervalued relative to gold. Now, the ratio has been coming down as silver outperforms gold, but it's still well above the historical average. If silver were to revert to a 15:1 ratio with gold at current levels, you're looking at silver prices that would shock most people. And there's a fundamental case for why that reversion should happen. Silver is rarer than gold in terms of above-ground inventories. It's consumed in industrial applications, while gold is mostly just stored. The supply deficit in silver is much more severe than in gold. By all rights, silver should be closing the gap with gold. And if the supply situation continues to deteriorate, it might close that gap faster than anyone expects. Here's another angle to consider. The mining supply of silver. Most silver isn't mined from primary silver mines. It's a byproduct of mining other metals like copper, lead, and zinc, which means silver supply is largely dependent on the economics of mining those other metals. If copper prices are low, copper mines shut down, and silver supply drops as a byproduct. The silver price alone often isn't enough to justify opening new silver mines because the economics don't work. You need high base metal prices too. This creates a situation where silver supply is relatively inelastic. It doesn't respond quickly to price signals. Even if silver prices double, you're not going to see a flood of new supply hit the market anytime soon. It takes years to bring new mines online. Meanwhile, demand is accelerating. The green energy transition is locked in. Governments around the world have committed to it. Electric vehicle adoption is accelerating. Solar installations are growing exponentially. This demand isn't going away. It's structural. So you have inelastic supply meeting accelerating demand. And the buffer, those vault inventories, is disappearing. This is the classic setup for a supply squeeze. And when supply squeezes happen in commodity markets, the price moves can be violent. We've seen it in other commodities. Nickel, palladium, uranium. When supply gets tight and demand is strong, prices can move multiples in a short period of time. Silver has all the ingredients for that kind of move. The question isn't if it happens. The question is when and how dramatic it will be. Now, I want to address something that skeptics often bring up. They'll say, if there's really a supply shortage, why isn't the price higher already? Markets are efficient. They price in supply and demand. And that's a fair question. But it misses a crucial point about how precious metals markets work. The paper market, the futures market, is much larger than the physical market, and the paper market is where price discovery happens. The spot price you see quoted is determined by futures trading, not by physical transactions. This means the price can be suppressed through paper trading even when physical supply is tight. You can sell unlimited paper contracts without having any physical metal to back them up, and that selling pressure keeps the price down. But here's the thing. That only works until it doesn't. Eventually, if enough people demand physical delivery, the paper market breaks. The price of paper silver and the price of physical silver diverge. And once that divergence becomes obvious, confidence in the paper market evaporates. We might be approaching that point now. The premiums on physical silver are rising. Delivery times are extending. Vault inventories are draining. These are all signs that the paper market is losing its grip on price discovery. When that grip finally breaks, the price adjustment is going to be swift and severe. Let me paint you a scenario of what that might look like. Imagine a large industrial user, a solar panel manufacturer, or an electronics company, realizes they can't secure the silver they need for production. They go to the futures market to buy contracts for physical delivery. But when they try to take delivery, they're told the metal isn't available. They're offered a cash settlement instead. But they don't want cash. They need the physical metal. So they go to the physical market and start bidding up the price. Other industrial users see this and panic. They start trying to secure their own supply. Investment demand sees the price rising and piles in. The whole thing feeds on itself. The COMEX tries to maintain order, but they can't produce metal that doesn't exist. Premiums on physical silver explode. The paper price and physical price diverge dramatically. Confidence in the futures market collapses. This isn't a far-fetched scenario. It's happened before in other markets, and all the conditions are in place for it to happen in silver. The smart money understands this. That's why you're seeing the vault drains. That's why central banks are accumulating gold. That's why premiums are rising. The people who understand market structure and supply dynamics are positioning themselves ahead of what's coming. And here's the thing about precious metals. Once a move starts, it attracts attention. Media coverage increases. More people become aware. FOMO kicks in. The move accelerates. We saw this in the late 70s. We saw it in 2011. We're starting to see it now. Silver is making headlines again. People are talking about it. And as more people talk about it, more people want to own it. This is how bull markets in precious metals work. They start slowly, driven by fundamentals. Then they accelerate as awareness grows. Then they go parabolic as speculation takes over. We're still in the early stages of this cycle. The fundamentals are in place. The supply deficit is real. The vault drains are happening. The monetary backdrop is supportive. The industrial demand is structural. All the pieces are there. What's missing is widespread awareness. Most people still aren't paying attention to what's happening in the precious metals market. They're focused on stocks, crypto, real estate. They're not thinking about the supply dynamics of industrial metals or the implications of currency debasement. But that's changing. Slowly at first, then all at once. That's how these things always work. And when the general public finally figures out what's happening, when they realize the vaults are empty and supply is non-existent, the rush for physical metal is going to be unlike anything we've seen before. Because here's the ultimate truth that most people don't want to face. The monetary system we've lived under for the past 50 years is ending. The dollar's dominance is waning. The debt levels are unsustainable. The currency debasement is accelerating. We're transitioning to something new. What that something new looks like, nobody knows for sure. But throughout history, during times of monetary transition, precious metals have been the ultimate store of value. They've been the safe haven. They've been what people turn to when they lose faith in paper currency. And we're entering one of those periods now. The signs are everywhere if you know where to look. The vault drains are just one symptom of a much larger shift that's underway. So what do you do with this information? That's up to you. But I'll tell you what I'm doing. I'm paying attention. I'm watching the vault inventories. I'm watching the premiums. I'm watching the price action. And I'm making sure I have exposure to physical precious metals. Because when this thing really gets going, when the supply squeeze becomes undeniable and the price starts moving in earnest, it's going to be too late to get positioned. The metal won't be available. The premiums will be prohibitive. You'll be chasing a market that's already left you behind. The time to act is when nobody's paying attention, when the fundamentals are in place but the crowd hasn't figured it out yet, when you can still get physical metal at reasonable premiums with reasonable delivery times. That window is closing. The vaults are emptying. The supply is disappearing. And once it's gone, it's not coming back. This isn't a temporary blip. This is a structural shift in the precious metals market that's going to play out over years, not months. The question you need to ask yourself is simple. Do you want to be positioned ahead of this move, or do you want to be scrambling to catch up when everyone else finally figures it out? The vaults are empty. The supply is non-existent. And the implications of that reality are just starting to be understood. What happens next is going to reshape the precious metals market and potentially the broader financial system. Pay attention. This is history unfolding in real time.